So yeah, good morning. My name is Hubert. I'm from Nestle Purina, and I've been in the category now for almost 19 years. And I have been part of an amazing journey in our pet care business. And today I'm responsible for driving with my teams the business development in Germany, Austria, and Switzerland, but at the same time also in Hungary, Czech Republic, Slovakia, Poland, and the Baltics. So I have an amazing region I'm responsible for, because the dynamics of the pet care markets in those clusters are actually very different. So that's one aspect that I like about my job. But the second aspect is also I had a fair share of involvement when it came to partnering with startups or making them part of our portfolio. So I've been involved in, not as an investor, but from a corporate perspective, to see if there is value for both partners to go through that acquisition process. That's another element. But the third aspect also that is important for me is when we have made them part of our portfolio, there is still the challenge to scale those companies. Yeah? And I'm still part of that process, so I'm coaching the business responsible people to see how we can best scale those businesses as part of a big corporate company. And I'm very happy to talk about the challenges that come with it. So this makes my job very rich. But today, it's not about talking about Purina. It's talking about, and the title says, dynamics in the DACH region. I think we can, and that's what I learned yesterday as well, we have to expand that because there is lots of participants from outside the DACH region to explore what that means. But again, important is, it's not me, I'm just a facilitator. So I thought, how do we do that? And the best possible way is actually to bring on stage two investors and talk about their perspectives, their experiences. And I ask the questions, and maybe every once in a while, I add some of my perspective. So with that, I would like to invite my two guests, Attila and Johan, coming up to the stage. And I read their biographies. Have a seat. I read their biographies, and I thought, if you could introduce yourself, but also at the same time mention something unique about yourself that might not be so obvious, but both of you have interesting aspects to add there. So Attila, I start with you.
Testing? Okay. Hi, everybody. First, welcome to this great, attractive office. It's amazing. My background, I've been in consumer for about 30 years. I'm originally from the US, but Hungarian background. I've lived and worked in 5 different countries. And most recently, I've been in the pet space for about 15 years. So starting in 2009, I, together with my team, built Partner in Pet Food to a pan-European leading pet food company. Sold it 3 times. So I've been in a lot of startups. I've been in your situation because I've had to pitch many times. I've had a lot of coffee meetings. I've sold the company 3 times in 2011, 2015, 2018. I'm still an investor, but I've stepped out, and for the past 3 years making my own investments. Family office, and I'll share a little bit later exactly what we're doing. And one interesting thing about me is before the consumer space, I was designing satellites, and I had the pleasure of working on the first satellite that successfully went to Mars.
Didn't know that. Good morning, everybody. My name is Hansi Hansmann. I'm Austrian. I'm living in Vienna. I was working throughout the most part of my career in the pharmaceutical industry, working in UK and 20 years in Spain, where I first was working for an international company and then building up my own company after a management buyout, which I sold successfully around 20 years ago. Then I started to invest in Spain, not as a business angel, just mostly in healthcare and a little bit in pharma. decided to go back to Austria at a time when I had an age to retire, to be honest. But it was a bit boring, so I thought, what can I do? And I did 1 or 2 startup investments and then realized this is exactly what I love to do and what I like to do. And whatever I have done in the past was kind of preparing me for what is coming now. So after that, I overdid, like I did many times in my life when I liked something. So throughout 3 years, I invested once a month in a startup. I have done until now, I think, about 75 startup investments, active portfolio of 50, 25 more than half of them I have sold successfully. Some of them are the most well-known and biggest exits in Austria, and I still love what I'm doing. Times have changed, as I was working more or less alone until 1.5 years ago, when I now decided to be more active. I hired a small team. We are now 4 people, 3 females and me. So 2 investment managers, one in Austria, 1 in Spain, in Barcelona. We're investing a lot in Spain due to my experience, which I had in 20 years in Spain. I really love to invest in Spain. And 1 personal assistant doing my back office. I still really love what I'm doing, but I cannot say that I'm specialized in pet tech, to be honest. But I mean, having a portfolio of 50 companies, there are some pet tech companies in it. There are exactly 2. I'm proud investor of Tractive since the very beginning, since 2013. And just recently, I made another investment in Hello Bello, personalized pet food in Vienna. And by accident, both of them we are co-investors there, Attila and myself. So looking forward today and meeting some of you and trying to help you. It's still a good time to do startup investments, believe me, and to found companies.
Fantastic. And you didn't mention the mountain biking aspect in your biography. So, when I look from my perspective, we get a lot of, I would say, requests to get in touch with pet startups, to buy them, etc. So I only have the category perspective. But as you are investors and you have a broader view, so how does that compare, what happens, the dynamic that we see in the pet space with other categories? Is pet care something special? And is there much more momentum compared to other categories, or how do you see that? And is the pet space more attractive, less attractive, equally attractive? So can you give me your perspective a bit on how you see the situation of pet space? The pet space, it's not just pet tech, it's also pet food, versus some other categories. And Johanna, I start with you.
Well, I would say it's a little bit more interesting for 2 reasons, pet care compared to the rest of the industries now. They started later than others. Other industries started earlier, so it's the right momentum now because they started kind of several years later than other industries. That's one reason, and the second reason is that pet care is kind of recession-proof. So there's less money available out there, and investors are thinking 3 times before doing new investments, before putting a lot amount of money into companies. So pet care is in a kind of a leading position, maybe. Maybe there are other recession-proof investments too, but pet care is surely one of them. I mean, we all know that since 1 year ago, or more than 1 year ago, we are in a quite bad economic situation. Startups don't get funding, or it's much more difficult to get funding. And if they get funding, it's at much lower valuations than it was before. I think that's happening everywhere. That's also going to happen probably in pet care. Just to give you one example, in 2021, the average revenue multiple for B2B SaaS companies was 22 times revenue, and the average of the second half of 22 was 6 times revenue. But that's reflecting more or less what happened also in stock exchange. I mean, most of the tech companies lost 60, 70, 80, sometimes 90% of their value. That has to be reflected also in the valuations of the new companies. But on the other hand, maybe it was a correction which was necessary, and it is what it is. We have to live with that. I mean, I was thinking, Kim, what you said before, I mean, when you said that the Swiss team is more successful than the Austrians now, I mean, throughout 1,500 years, the Austrian skiing team was much better than the Swiss skiing team, just not the last 2 years, but we live today. And that's exactly what's happening also in our economic situation. We are living today. We have to live with what we have. If you are good, you get money.
Well, the past 10 years has been really free money, and over that time then pet food and the pet space has been competing with other technologies, other consumer sectors and other sectors. But as Hansi mentioned, probably the last 6, 9, 12 months, with rising interest rates, then there's a possibility for people to put money someplace else, not just investing in companies, not just the stock market, lower risk. And now interest rates continue to rise. Times are becoming more volatile. Recently we had the Silicon Valley Bank issue. Yesterday I think Credit Suisse, much to everybody's shock, is in danger. So there's growing volatility and there's a flight to safety. What does safety mean? It means maybe treasuries, so almost cash-based, but it means also, as we heard, safe industries, and pet is recession-proof. So we looked at the last 2 recessions in 2008 and 2000, the dot-com bubble. We did studies on that. What do pet parents do, or what do consumers do during recessions? What we found is people will stop buying orange juice to save money. They can drink water, so there's an easy substitute. But the pet needs to eat, your baby needs to eat, and somehow health and beauty also continues to grow for an amazing reason. But the pet space is very recession-proof. So now what we have is we have a similar amount of money, especially private money, looking at fewer good assets, fewer good industries. So valuations have come down drastically, as Hansi mentioned, from 21, 22 multiples in SaaS companies down to 6. I've heard in some cases down to 4 or 5. But since you have a wall of money looking for great investment, then the pet space, one can argue, has not come down that much. So if you're a great company, it hasn't come down because everybody wants to get in. You have not 5 people wanting to invest, but 50. So you have great competition. Of course, if you're a mediocre company or underperforming, then your valuation has come down. Also, something that has changed is cash flow. Over the past 10 years, people, especially startups, have had a certain runway for 12 months, and they had the model, after 12 months, I run out of business, but money's free, everybody wants to invest, so I'll raise money, and they've gone through round after round of fundraising, always losing money, but maximizing growth. And a prudent way, one of my investment criteria is companies have to be cash flow positive or a very short path to cash flow positive. That means the next 3 or 6 months. And that is required today if somebody wants to invest and get money. So that's changed.
Yeah. Thank you. And by the way, partner in pet food, whenever I visit my markets in Eastern Europe, I'm very impressed about the progress that you guys, or they have made or are making. So very strong competitor. Very well done.
Well, we were dancing in the same ballroom for many years, right?
Yeah, exactly. So the title says DACH versus Eastern Europe. When you look at the dynamics of the pet space across Europe and the startup scene, do you see from your perspective differences? You know, is Berlin still the Silicon Valley of Europe, for example? So what's your perspective on that?
Was Berlin ever the Silicon Valley? I would say, in general, Tractive is a wonderful example. Look where they are based. They are in Linz, or not even Linz, you are in Pasching, no?
Yeah, exactly.
And that's not the only big company here. I mean, Rantastic was founded 500 meters from here, and there's another company where I'm invested, Hello Again. They are also 500 meters from here. What does that mean? In fact, you can start your company everywhere. The only thing you are missing maybe, and this is a disadvantage, you need an ecosystem and talk to other people. That's easier if you are in a place like Berlin or London or even Vienna. On the other hand, there is cheaper labor than in Berlin or in London, by far. That makes the difference. So it has more advantages, and that's a good example that it works. VCs find you everywhere. If you have good KPIs, you approach VCs, or they find you, and you show them that you have good KPIs, you get the money, whether you're in Berlin or you are in Pasching. So I don't think that's a really big, does make a big difference. If your question refers to are there differences between the countries, I mean, I can only talk from my own experience, because I had a dog when I was living in Spain for 20 years. That, for example, was a big difference. I remember when I had a German Shepherd, in Austria I was used to go to any restaurant, I was sleeping in any hotel with my dog, it was no problem at all. That was a huge change when I came to Spain, because dogs were forbidden everywhere. No restaurant, no hotel. What does that mean? In Europe, I mean, we always talk about Europe as a market. Europe is not one market, as we all know. It's 27 different markets, or even more different markets. But that has big advantages on the other hand, because I have seen many more companies starting in Europe, being successful in Europe, and then going to US than the other way around. Because if you are able to be successful in different European markets, it's kind of easy to go to the US. If you're just successful in US, you have very little chance to go to Europe and be successful here.
Okay, thank you. Attila, your take on this.
Yeah, I'm not sure if talk specifically about Berlin, but if we can talk about countries, then certainly Germany has a great ecosystem and a good history of startups, companies that grow into global companies. Certainly Austria has a great ecosystem as well. A lot of support from the government. The mentality of the people is very entrepreneurial, innovative, and so on. The UK, very similar, great ecosystem, a lot of startups and so on. But there are cultural differences, and if you look at the DACH region, or let's say Germany, Austria, versus the UK, Tractive, as we mentioned, is here, it's 10 years old. It's on its way to become a unicorn. That's a fantastic success story. If the same thing would have happened in the UK, then let's say they had the same trajectory, the founders probably would have sold it when it was 50 million, 100 million, 200 million in valuation, stepped out, retired, and then probably gone sailing in the Caribbean. So the DACH region is more long-term, whereas let's say the UK is more short to medium-term. And that's a very big cultural difference. So here it's a much longer-term game. Of course, you need to reach your short-term targets, but then you have a 5- and 10-year goal that I want to be valued at 100 million, $500 million, then how can I become a unicorn? And that's very exciting rather than just selling early.
Yeah. So, apologies, I'm going to go off script now. Michael, I'm improvising, but we had this morning a short conversation about building the business in Pasching, and we are not just in Linz, we are in Pasching, and now everybody knows where Pasching is. Yeah? I would just be interested to understand from your perspective, what are your challenges and why do you think you made it here and not someplace else?
Yeah, maybe one of the reasons the reason we did it here in Pasching is because we had the opportunity with the founders of Rantastic that Hansi was involved with to get free or inexpensive office space from them. We could use the environment, the office that they had here. That was the reason why we actually happened to be in Pasching. And then once you start to be 20, 30 people, it's not that easy to move to a different place. But I think we had great access to talent. We don't have a talent war like in Berlin or London or other cases, so that's definitely something that's an advantage. I think from a disadvantage perspective, is probably once you're at the size like we are, getting key talents in certain positions that just happen to be in London or in Berlin or in Düsseldorf or in other places. And it's quite hard to get them to move to Linz because they don't know where it is in the first place, right? So those are certainly challenges, but we have overcome that. There's quite a few people here that have moved from all over the world and that are great talents moved to us, but I think that's, I think you can do it from anywhere, really. It doesn't matter where you're from, especially if the product is digital in nature.
Thank you for improvising. You mentioned that Tractive is on the way to become a unicorn, right? So, and when you look at the participating startups here, it's a very broad set of different business models, propositions, etc. But from your investors' perspective, what are the hot topics that are out there today, if there are any, and what are you specifically looking for in the pet space? Johan?
Well, I cannot say what I'm specifically looking for in the pet space, but I can tell you what I'm specifically looking for in general, which also would apply to the pet space. I would look for recurring business models, and they are also possible in the pet space. Tractive is one. And the big advantage of the pet space is that recurring business model depend on it's always important to know the lifetime of a customer. And the lifetime of a customer in a pet space is very often very much linked to the lifetime of the pet, whether it's 10 years or 12 years or 14 years. And that's a huge advantage compared to any other recurring business model in any other industry, because you normally don't have that. So retention rate is very high, churn is very low, and that's true, obviously, for most of business models in the pet space. At least I can imagine that. I don't know so many. Because also, I mean, pets cannot talk. They cannot tell you what they want, not really. I mean, they can show you what they do not want, but they cannot tell you what they want. So if you have found something, what they like, you're not likely to change that. Because you see, it's nice, it's fine, it works. Why should I change that? Why should I risk that? Even if your dog would like to eat something totally different, but is quite happy with that, you will never change that. So think about that. That's very important. That's a strong characteristic, if you want, so USP of the pet space. And as in any other industry, when we talk about recurring business, we're talking about the most important KPIs. What is your customer acquisition cost, and what is your lifetime value? And the quote between the two. I mean, there was that quote which was used by VCs over the last years, 3-to-1. So lifetime value to customer acquisition cost, what VCs are looking for is 3-to-1. I think that's going up now. It's 4 or 5, if you really want to. You have to be really much better than anybody else to get VC money. So that will change, but I mean, that's at least the goal you have or you can work on. If you have less than 3-to-1, don't even talk to VCs. They will not look at you. That's a very important advice I could give you. You're losing time.
Okay, thank you.
Well, one thing I look for is growing markets, and certainly the pet space is growing. When I was thinking about joining PPF, our partner in pet food, in 2008, I talked to some friends who I respect and considered advisors, and they unanimously, all of them told me, don't go into pet. It was good, it's being commoditized, profit margins are under pressure, and I do what I often do is when people tell me to go left, then I go right. So I went into pet, and I realized then that if you have a strong USP, so something where it differentiates you from everybody else, not only the USP, but you're better at executing or the best at executing, then you can win. You can grow margins. You can grow dynamically. Also, investing in Tractive, I learned about the subscription model because at PPF we were transactional. You sell a package, that's one time, and the next time you have to sell a package again. So it's quite a tough business. But subscription, you sign up for a year, or a month, a year, 2 years, and you have that reoccurring revenue. So that's fantastic. Also, cash flow positive. So Hansi was mentioning some KPIs about lifetime value divided by customer acquisition cost. Also, cash flow positive or road to cash flow positive gives financial independence. And if you have financial independence, you're your own master to figure out and chart your own path where you want to go, rather than having to chase money every 6, 12, 24 months. So that's very important as well.
Yeah.
You have clearly seen now the difference between our approaches. No? I'm an early stage investor, he's a later stage investor, he's looking for cash flow positive. If you're an early stage investor, you cannot look for cash flow positive, at least not in the first 2 or 3 years. Under normal circumstances, there might be exceptions. So I'm not looking for cash flow positive.
But also what I learned in meeting Hansi is He's invested, you said, in about 70 companies and multiple, multiple companies. I've missed the multitasking gene, so I invest in 5 to 10 companies maximum. So.
It's cash flow positive. So from a corporate perspective, when we look at options to make a startup part of our portfolio, it must be more than cash flow positive. There is a clear track to accretive profitability levels, because one of the challenges is that with those businesses that we buy and add to the portfolio, they need to add more from a profit perspective in the long term than what we have today, and make that bottom line better, so that we can generate the funds and continue to invest in growing the business. So that makes it also then sometimes challenging, I would say, when we talk to those particularly growth-oriented startups, to make them part and bring them into our framework. And yesterday I had some interesting discussions, because sometimes as a big company, we are just not the right parent to grow a business, because it needs to meet certain requirements. We are looking for startups that we can scale in multiple markets, geographies, ideally globally, and not just in a specific geographic area like Central Europe or the DACH region. I mean, never say never again, or never say never, but at the same time, this is what we are looking for when we talk to those startups, and that's how we look at the business case and the scalability and the ability to internationalize it. So that's always a bit of a significant challenge and a different perspective, early stage, late stage, and then with us. We have seen yesterday, I talked to a lot of people, and one of the elements that people are usually looking for from a startup perspective is also the coaching element and the advice that you can give them. What are the usual sort of mistakes that you see, or the challenges when you talk to startups that need to be prevented in order for the startup to thrive? Is there 1 or 2 or 3 things that you can leave with the group here?
Well, it's a long list.
I know.
But there's one main point which I would like to give you the advice. This is focus. Focus on one thing. It's much, much better to do one thing excellent than to do 2 or 3 things just good, or even very good. That's not enough. I mean, as a startup, you can only be successful if the product you have is, I mean, they say 10 times better than anything else. That doesn't mean exactly 10 times, but much, much better than your competitor. Then you're going to be really successful. And you can only do that if you focus on that. I mean, also Tractive is a good example. I think Michael mentioned that at the beginning when we said, because we were thinking maybe instead of pet, or in addition to pet care, we could go to humans or do whatever, because it's a tracker, it's a GPS tracker. Everybody could use that. It's so important to decide for one vertical and to work in that vertical and be a specialist and known by everybody and know in detail all the problems of this vertical. That's a very good example of focusing. Because at the very beginning, maybe we would have sold more just selling to everybody. But long run, one vertical is extremely important. But in general, focus. And that's not just for you as founders. You should also try to teach your people working for you to focus on one thing. And do that, and if after 3 or 5 or 6 months you say it's not working, because it can happen that it's not going to work, then take the decision, stop it, and decide for the next thing you have to focus. But never do 2 or 3 things at the same time or in parallel and say, okay, I will try this and this and this, and I will do it very good, and one of that will really work out well. That's not going to work.
Yeah, I would agree. It's probably 3 things I see. First, focus is what Hansi said. Second is execution. And 3 is know your business. And somebody earlier mentioned ideas. And everybody has a lot of ideas. We all have ideas every day. But who acts on those ideas, and who acts on those ideas successfully? And once you start a company, what I look for, and what I was very impressed with, for example, in Tractive before I invested, is I asked Michael, isn't this a commodity? Can't everybody do this? And the answer was yes. And I said, well, what's so special about you? And then they explained it, and they explained they're working only on one thing, and that's dog and cat GPS tracking, transitioning to pet wellness, and then execution. They were really best in class in executing. So it's not just having focus that I want to do this one thing, but you have to actually implement it, and you have to implement it in a timely fashion. We're actually using resources efficiently. Resources are just people, time, and money. It's that simple. And then the third thing is know your business. So I ran a business. When I asked Michael a number, then they had the number immediately. If they didn't have the number, then an hour later I got a detailed spreadsheet with everything I wanted to know, even more than I wanted to know. And you have to know your business. And quite often I talk to people, startups, growth companies, even mature companies, and I'll ask them a basic question, and they can't answer it. They can't answer the question. I'll say, what is your current run rate? Well, our revenue last year was something. Well, I didn't ask you that. What's your current run rate? And they won't know a basic number. And so you have to know your business and better than anybody else. So those are the three things I would say.
And Johan, before you mentioned that Europe is a collection of many markets compared to the US. That creates challenges, I would guess, for startups to roll out their business model across Europe, and more if it is a product-focused proposition, and maybe less a bit if it's a service-focused proposition. But how do you see, or what are the sort of conversation that you have when in the business plan you see, we are going to expand quickly into different markets, et cetera, and what is your experience there, and what is the advice you could give to some of the startups?
Well, the advice is very clear. I mean, start with your local market. If it's an Austrian company, try to be good in Austria. Try to make the product really good in Austria, and then the logical region where you expand is the DACH region. It's Switzerland and Germany. And if you're successful in Germany, you can be successful everywhere. That's what you normally hear, and what's really true in many ways. And these expansion plans where you say, okay, I'm going to cover Europe in the next year or in 2 years, that's just not working. It's just not possible. There are so many differences, starting with legal and regulation and different marketing and different culture and different mentality, different way to buy, pricing points are different. All that you have to consider and learn country by country. I mean, starting with the big countries, obviously. I mean, you will not start with smaller ones because the effort is more or less the same to start with big countries. But once you have that and you have 5, 6 European countries, then you really know your market, you know Europe, and it's much easier to do the rest. But it's one country after the other, and not too quick.
I would agree with that. So first, when you start, if you're starting in a small country, you need a big country next to you, like let's say Germany, Austria, so the DACH region. If it's the UK or France, then you have to prove your business model in your home country. Proving the business model means it's sustainable, dynamic growth, pathway to cash flow positive, and then you can expand. It also depends on your goal. If your goal is to be a unicorn, maybe that means you have to go into multiple countries. An example is InPost, which was a temporary storage facility in Poland, where only in Poland they became a unicorn. Then thereafter they expanded to other countries throughout Europe. So there's different ways, but initially you have to prove your business model in your home country so that people have confidence this can work, and then go expanding to other countries as well.
And I can only reiterate and reinforce that message. When we receive business plans that are built on a rapid expansion across Europe, that usually doesn't happen for all the reasons that you mentioned, particularly if it's a product, a service as well, but particularly if it's a product. And I see that in my daily life with, for example, Terraganis that we acquired, to really bring the proposition, the language element, etc., alive, and the regulatory aspect, etc., in a specific market like France is a huge challenge, takes time. And that brings me to the second point is, when you are in your home market successful, and it has taken you a long time to get there, and suddenly it's taking off, it's very unlikely that this is being repeated or that it's quicker in other geographies. So the patience needs to be there, and the sense of realism needs to also be part of the business case. Because otherwise, that can undermine your credibility as a founder team if you're too optimistic, and that's also something that we look at. But this is really one of the difficulties you have expanding in Europe, from my own personal experience. Yeah. So you mentioned before that funding pots are drying up. It's becoming more difficult. Business plans are scrutinized much more, and we have a few early stage startups here as well. So what is your advice or view on how to set up the funding? What should a founder do? How should they approach that topic? Attila, whatever.
Well, certainly the classical way, if you have your own funds, that's the best. Then family and friends, then going out to acquaintances, hopefully proving your business model so that when you go out beyond acquaintances, then you can get better conditions. Certainly funding is, I wouldn't say drying up, but getting more difficult to obtain. So you need a very sound business case, hopefully something proven rather than just an idea. So, and then VCs, of course, the cost of VC money is increased. People like Hansi and I, we offer what we call smart money, I think, so money plus advice as well, so we can help guide you as you're growing your business. So I would say those are the main routes.
Well, I agree with you, Attila. I mean, it always depends on the phase where you are. If you start a business now, I think it's a good moment, to be honest. It's not a bad moment, because to start a business and to get the first money from family and friends or even from business angels, that has not changed so much. I mean, also valuations have gone down, that's right, but you will get the money. Let's say your first 300,000, 400,000, 500,000 euros, that's still possible. Try to cover the next 18 to 24 months with that, and hopefully at the end of that period, times have already changed. You never know. If you're already in a later stage, then you will have tough times. I mean, I have to say that very clearly, because what happened during the last week with Silicon Valley Bank and Credit Suisse will make things more difficult. On the other hand, for example, more than 1 year ago, beginning of 2022, startups were given the advice to have a run rate at least until mid-23. Many have done that. They will going out to do fundraising in the second half of this year. So everybody will need money, and not all of them will get the money. On the other hand, for companies that are in a good position, there will be assets on the market which will be cheap to buy or to integrate or to do share deals or whatever. I mean, it's exciting times ahead. But if you're looking for a Series A, for example, it's going to be difficult. My advice would also be, if the terms are not good, and the terms will not be good, it's not just valuation, it's kind of 1 time or 2 times liquidation preference and things like that, which we haven't seen for many years, but we will see that in the future. Even that, it's always better to take the money than not to take it. I mean, if you need the money, or the alternative is to close down the business, take the money and take more than you think you will need. Have more months where you can work on your product and on your market strategy.
And Johan, any view on at what point in time bringing a strategic investor like Purina on board makes sense?
Very late. I mean, very late. I mean, there's a clear explanation for that, because in the moment you have a strategic investor on board, your only exit route is that strategic investor, and all others are gone. Whatever you have agreed in the contract, whatever strategic investors promise, you can go out and talk to them. It's no problem. We'll always, and it's not just the strategic investor, the company itself. It's even the CVC. It's the same name. I have suffered that, so believe me, I know what's happening here. The moment you take a strategic investor on board, you have one route if you are successful. And if you are not successful, I mean, if it's not a really good case, then it was not a good idea to have the strategic investor on board, to be honest. So think about it. On the other hand, if your only alternative is to take a strategic investor on board, take him.
Yeah, two answers to that. On one side, very late, because when your business is mature and you're ready to step out with perhaps a transition period, then it makes sense to sell to a strategic investor. On the other side, similar to Nestle, more and more strategic investors, global companies are saying, how can we turbocharge innovation? We've been trying innovation the past 20 years or 100 years. We have an innovation team, but much to my surprise, they come up with no innovation. So how can we get access to innovations? And they're starting their own funds like you with Unleashed to harness the creativity and the speed and the entrepreneurship of everybody in this room. And then they create a certain ecosystem to support you, but not hold you back. And at a certain point in time, then, yeah, maybe you buy it and take it over. So, so I see really a why going. So the road's going in two different ways. One, when your company's big enough and you say, okay, I've had enough, I want to retire and cash out. Or the other is, I want somebody to support me, but maybe for the midterm, maybe for the long term, like Unleashed or something else. So,
okay. Thank you. So you see, we are not shying away from more difficult questions here. And I'm ignoring the time budget that I have available as well. But I do that deliberately anyway. As we are at the end of the time available, one last key message or advice that you want to leave with the group before we go off stage? Any?
Times of crisis or volatility like we have now, so many times people are looking for security. How do I ensure the next 12 months, 24 months? I would say this is one of the best opportunities to start a company because everybody's maybe not starting a company and thinking about the security. And as I said in the beginning, when everybody's going left, you should think about going right because you'll have access to good resources at a fair value. We hear layoffs every day. People are being let go from their jobs. That means great people will become available at perhaps a lower price. You'll set up your business, you'll prove your business model, and then in 6, 12, 18 months when we come out of the recession, and everybody starts thinking, no, maybe I should start a company because the recession's over, you'll have a 12 or 18-month advantage, and you'll already be going at 100 kilometers per hour when they're just getting started. So, so that would be my advice, is go against the grain when you think about things.
Yeah, I fully agree with that. In addition, I would say that at the end of the day, it doesn't change the overall tendency. Innovation is happening in startups and will happen in startups. Even in crisis and even in 5 years or in 10 years, it will not happen or nearly not happen in corporates. It will always happen in startups. So I think, in general, apart from the crisis, we are only at the beginning of the big startup world. There's going to happen much more in the next 10 or 20 years. There will be many, many, many more startups because there will be so many opportunities with tech companies, with digitalization, with software and intelligent hardware to do new business models. So the world is open for you. It's not changed because we are in a crisis now. I mean, in 10 years from now, we will look back and we'll talk about the dot-com crisis in 2000, 2001, and the 2008 crisis, and the 2022-23 crisis. And what has it changed finally? It's like that. And that's going to happen this time too.
And my last point from a strategic investor's perspective is also make sure you have or use us as advisors or sounding boards and coaches as well with our category expertise. We don't always need to talk about investments, so there's other opportunities to connect, and Unleashed is very much about this. So thank you very much, Johan and Attila, for joining me. It was a privilege to have you here on stage and to be able to have that sort of conversation with you. So thank you very much for doing that with me, that experiment. Thank you. And with that, I think we come to a close. Thank you very much.